Hello again, and welcome to our Hightower Signature Wealth monthly fireside chat. Our goal, as last time, is pretty straightforward. We want to step back from the daily headlines and provide our clients with thoughtful perspective on what truly matters for long-term investors. I'm Matthias Kuhlmey, Chief Development Officer at Hightower. And joining us, as always, is Stephanie Link, our Chief Investment Strategist and Head of Investment Solutions at Hightower. Over the next 30 minutes, we want to focus on several developments shaping markets today, including the geopolitical environment, the so far resilient US economy, and recent developments in private credit. And Stephanie, when I asked you to coverage, what should we be talking about? I loved your to the point guidance. War, private credit, economy, and I'm buying versus selling. And I'll sort of take us from there. Stephanie, compared to last month, a lot of things have changed. Let me say there's no shortage of headlines right now. And yet markets have remained sort of relatively calm, trying to figure out maybe the new normal with the broader environment. So let's start with the global backdrop. Of course, geopolitics and market resilience are on our mind. We have seen a significant increase or start of global tensions and regional conflicts that remain elevated. Stephanie, given the current backdrop, how do you consider the rising geopolitical risk in your portfolio positioning?
Well, if I were to tell you, Matthias, that we would have had the situation happen in Venezuela and we had the SCOTUS ruling on the tariffs, which was the
That's right.
reversal. We have private credit, which I'm sure we'll get into, but more than that, it's AI and the attack against employment and the attack against every industry. It seems like once a week, AI and the concerns about AI taking over various different industries, and every industry has gotten hit each week, which has been crazy. But if I told you all that, would you actually think we're only in a 4% drawdown? We're down 2% in the S&P 500, and we're up 1.5% in the equal weighted S&P. That to me is the most surprising because we have gotten a lot thrown at us and we're hanging in there. And I think a lot of that has to do with the resiliency in the economy. The economy
Right.
is slowing for sure, but it's still running about 2.5, in fact, 2.7% is the Atlanta Fed tracker, the most recent number for this current quarter. And while I know there are concerns about the labor market, especially if you look at non-farm payrolls, and then again, you talk about and listen to AI and companies laying off, the weekly jobless claims remain historically low at 213,000 on a 4-week blended basis. We do an average because in weekly data, it's just too short term. Even if you go 3 months back, you're at about 217,000. Remember, recessions, you see that number closer to 350 to
That's right.
375,000 weekly claims. So there are puts and takes in the labor market. We are cooling, not collapsing. But I also look at the consumer continues to consume. If you look at retail sales, core retail sales last month rose 4%. And if you look at the manufacturing side of the economy, the ISMs are now up 2 months in a row. It's only 2 months, but 2 months above 50. We haven't seen that in 3 years. Manufacturing is being driven by AI and what you and I talk about all the time, the food chain of AI. AI, you need to make data centers, you need to make better grid manufacturing, and then you need power. All of those industries are benefiting from AI. And by the way, today, NVIDIA is having a conference and they just said their backlog is $1 trillion between now and 2027. So my point being is the food chain is still going to benefit in a big, big way. So you have the consumer consuming, manufacturing doing fairly well. That's what's driving the 2.5 to 3% GDP. And why do we care about any of this? We care about it because it leads directly to earnings. If the economy is growing at 2.5, 3, you could probably do 10 to 12% earnings growth. I'm not sure we're going to see that this year. There's a lot of factors that we can talk about, but I would take 8 to 10%. And I would even take 8 to 10% in the S&P 500 for the year in terms of total return. The
That's
long-term
right.
average is about 7.7. So let's see how it all evolves, but it's very encouraging that we're hanging in and we're better than hanging in with all the stuff again, that's coming our way.
I mean, Stefan, you said it very well. The markets have been under attack, politically, geopolitically, and yet it seems this economic momentum is carrying us. It's stronger than many had expected. Economic data continues to show resilience. Inflation pressures are easing. You said it in our last session. But now the key question, is there still the risk that the market could, fall off that proverbial cliff? Do we see more of a late cycle environment, good data playing out, or is there more durability to this move and to this economic expansion?
I think that there's more durability, but as I mentioned, I don't think it's going to be like we saw last year, 18% growth in the markets. I'd be
That's right.
happy to be wrong on that, by the way, happy. But I
Yeah,
think we should feel good about 8 to 10%. Remember, AI is leading growth. However, it's also helping productivity. And you and I have been in this business a long time, Matthias.
that's right.
I can't tell you the last time we saw productivity grow. Last quarter, 5.2%. In the current quarter, it's running at about almost 3%. That is very powerful because it also will help the inflation situation. That's number one. Number two, we have yet to see the benefits from the one big beautiful bill. Now, higher oil prices is a worry. Absolutely. You can't have
Yeah,
$3.70 at the pump. That will eventually get to and lead to demand destruction. Not now, not at those levels, but if you get closer to what California is seeing, absolutely you will see demand destruction. But maybe the one big beautiful bill and the tax implications that are from that, which should help the consumer, maybe that helps to offset some of the inflation ahead of the productivity kicking in.
right. I mentioned falling off the cliff. It doesn't apply to the economy, but we see some noise
Oh,
in private credit.
yes.
And you and I talked, you actually just published a great piece with our colleague Robert on, separating noise from reality. So private credit continues to attract investor attention, significant headlines. My question to you, Stephanie, how should investors look at the current conversation around private credit?
So I think there are some bad actors. I think that there were definitely some fraud in some of the various different situations that we've heard about. But I do think after listening to the large bank companies last week, they were at RBC, they had a conference. Their private market, private credit, very well secured, and they feel very good about the marks, even though they might be marking down the marks. At least they're being conservative and getting ahead of it. And I think from the private market companies in general, the big ones are, I think, okay, just better than okay. They are very seasoned. They have swarms of people that are looking at their lending and the lending behaviors and the projects that they're involved in. Plus, they're very diversified. Now, would that make me go out and buy a public private markets company? No, because I do think it's going to take a while to get proof points that it's not the end of the world, right? I mean, it's not the end of the world. Of course, we know it's not, but it could be a credit cycle. And I think until you get more companies that show that they are fine, then I think the confidence will come back. But what I do think is the opportunity are some of the big banks and the financials because they are actually taking back market share that they lost from the private markets companies since the great financial crisis, number one. And number two, they're very, very diversified. So is it going to be another credit cycle? There will be a credit cycle at some point, Matthias. We know that to be the case. We haven't really had one in 15 years. And that's because
That's
of
right.
the regulators have regulated the big banks and they can't get
Yeah.
themselves into trouble. The private
Yeah.
markets companies, it's a little more opaque. The transparency is not what we would like it to be, but that's the very definition of what private markets and private credit and what all of these companies' alternatives are providing or lack of providing. But they're very diversified too. I think you just want to stick with the great managers, and that's why you do need a strong team of manager selection, which we have at the firm, and Robert at the helm and Frank, both of them are just amazing in terms of their knowledge. And so that's why they put together a select list. So I'm not thinking that you're going to see a credit cycle from this situation. I could be wrong, but from what I see and from what I hear, um, redemptions are kind of scary, right? Especially when you hear them at like 14, 15 and they're getting gated at 5. It means that you're going to see a while, it's going to be a while before these redemptions get filled. Because if you're gating at 5 and you have 14, it's going to roll over to next quarter and next quarter. And in fact, I had Henry McVeigh on from KKR, one of the founders. He was on a webinar last week, and he even said, first and foremost, he said exactly what I just said. Like it's not great, but it's not horrible. But he also said it's going to take a while to play itself out for these redemptions just to kind of clear through. And I think what's happening is there's so much negative commentary and there's like a frenzy that the retail investor, they get scared. And so they
Yeah.
don't know exactly what they own. Maybe they didn't realize the illiquidity or the fact that you couldn't necessarily redeem 100% of what you wanted and that it will take time.
Yeah.
But I think it's all about further education. And now more than ever, our advisors should be talking to their clients nonstop. I had a conversation with one of the advisors, one of our advisors last week, and I said, if I were you, I'd be on the phone 24/7, just talking to them and calming them down, telling them exactly what you own and why you own it, etc. It's a good time to be helpful and to communicate extra to try to just calm people down and say, we're in these things for a reason. And if you're not comfortable, okay. But I just don't see this disaster right now, but we're watching it for sure.
It's definitely, you said it perfectly. And this is also why we have good advisors, right? This is sort of where the
Yeah.
quality of the advice formula, as I call it, comes in. Stephanie, you touched on it a bit. I just want to bring it back in a closing follow-on question. When we look at the structural dynamics in credit markets, how important is a fund structure, when I, as a retail investor, want to sort of assess my private investment?
Sure. Well, I mean, that's one of the reasons why some of the fund of funds companies we don't recommend as much because you don't have as much control. So this is where you have to really dig in and see what do you own? Do you own kind of directs or do you own fund of funds? Do you own a combination? And how comfortable are you with what is being invested without as much control? And so I think it's something I think it's very important to that's why I say it's so important to go to the advisors, don't go to, for the advisors to go to the clients, say, this is what we own, this is why we own it, and we feel good because of this. It's a much more clean structure. Fund of funds is a bit more of a question mark because you just don't have that control.
Thank you. And just sort of, I'm summarizing everything I've heard. Really good advice. Liquidity management is critical in illiquid asset classes, and we need to know about this. Structures that give managers flexibility during stress actually may protect the portfolio value. So we need to look at this as well. And then manager discipline. You know, you talked about the great firms we have access to, and you are speaking with. Manager discipline and collateral quality remain then central to this investment decision. So
Well,
thank you.
100%.
I I couldn't agree more with you. Switching back from the credit markets back to more common territory away from the headlines. Stephanie, when you look across your discipline, where are you currently seeing the most compelling opportunities in the market?
Well, those sectors that got hit really hard for the week or the 2 weeks that, or even longer than that, that because of AI and the potential for the disruption. I do not think software is dead. And in fact, there are many
Mhm.
stocks I have not owned in software because of the extreme valuations. I have been picking through high quality software companies with great balance sheets, great free cash flow, the companies that have number one or number two market share that are truly on sale, and you can pick a bunch. Mission critical software is not going to be disrupted from AI. It's mission critical for a reason. Cybersecurity is not going to get disrupted because of AI. In fact, AI is the reason cybersecurity is necessary, especially as
Mhm.
some of the big players, think hyperscalers, that are using 50% of AI, to code. to code. If you're using
Yeah.
AI to code, that's more dangerous than having a person. People make errors, human errors, that's for sure. And there could be some that are very bad characters. But AI is a different mindset altogether. And really, when you talk to these big cybersecurity companies, they almost, I don't want to sound smug, but they almost laugh at the notion that AI is going to take over their business. We're just in the beginning stages of cybersecurity and what we're going to need, companies, what they're going to need, and what the big players actually can offer to companies. Talk to Doug Baso. I think we talked about this last time. Talk
Right.
to our CTO. That's that talk about mission critical. You need cybersecurity, and he says I'm still learning about AI. We all are still learning about AI, so we need to invest there. But we can't afford to wake up and lose the business overnight because we don't have the proper cybersecurity. So to me, that's one of the areas. I think the financials I mentioned briefly, the big banks, the big six, are very interesting to me because they have been down. They're the worst performing group year to date, and they're trading almost at one times book value now. As some are trading below one times book. Historically, that's a very good time to buy. And as I mentioned, I think they're taking market share, and I think the business activity has been really terrific. And most of these companies reiterated guidance just last week. So if they're reiterating the guidance and the stocks are down 10, 15, 20%, I think that that's an opportunity. I'll tell you where I'm trimming. I'm trimming energy
Mm,
because I've had an enormous run and nobody wanted these stocks in October, November. And they've run quite a bit. And I do think eventually, if you believe the administration to be short-lived, I don't know, none of us do, but if in fact it is short-lived, I think you're going to see a pullback in energy and in oil, and the stocks are really highly correlated to oil. But I can find Matthias ideas everywhere. And there are in consumer, in discretionary, in housing, all of the themes that we talk about all the time. There's a reason that I talk about themes because if I believe that they're strong total addressable markets over the next 10, 15, 20 years, well, when we get drawdowns like we have in some of these sectors, well, that's got to be the opportunity to be buying. And so I think it's a little bit more stock specific this year so far. I hope
yeah.
that's the case because I tend to do better when the Mag 7 don't do as well because I'm really not there. I'm in a few of them. But there are a lot of opportunities and just trying to stay with your process. And sometimes, Matthias, even I have to turn off the TV because it's so negative. And I'm okay. I want you to watch me, but not that badly. I don't want you to be scared. So sometimes it's just prudent to turn the TV off.
I haven't been scared watching you on TV, and I trust it will keep this way. Love your perspective and hence also your incoming guidance. By the way, I'm buying versus selling, but I may be trimming a little bit. So really just to capture, you're still big on industrials, the infrastructure tied to AI and energy demand, select financials benefiting from productivity improvements. We talked about our industry. And then I think that's the classic companies with strong free cash flow and the pricing power. Um,
I think the reason the Mag 7 haven't done well this year is because of free cash flow.
right.
Some of these companies are going to have negative free cash flow. They're spending
Yes.
enormous amounts of money to build out AI, and they should, but at the expense of free cash flow. To me, that's bothersome. It's not the end of the world because they're investing so that they can continue to see free cash flow in the many years to come. But this year, I think that some of them, not all of them, but some of them are in the penalty box for that very reason, because it does drive equity price. Cash is king. You could do whatever it is that you want whenever you want to, and you can be offensive, you can be defensive, you can return it to shareholders. It's a very powerful thing that when you go negative, it's a penalty box. It's 3 months, 6 months, a year, I don't know. But that's why I think that they've underperformed year to date.
Stephanie, let's stay with the Max 7 for a little bit. I sort of hear the voices that we potentially see a significant rotation, that the darlings that used to be hot and well performing are sort of moving in the background, and we are looking more at, other geopolitical plays the gold miners, the silver miners, oil, energy, soft commodities, agricultural goods. What is your take on that larger rotation over the years to come?
Well, if you believe that the growth in the US is going to be above trend, which I do, you do want to you want to lean a little more cyclical. So, right, if you have better growth and the companies that are tied directly to the economy, those are the cyclical companies. Those are the industrials. Those are some commodities, especially copper. You and I've talked about copper endlessly, I know.
Yeah,
Um, and and it's financials and it is discretionary. It's all that. Around the world, it gets a little more complicated because everybody did that trade last year. Everybody
yes,
left the US, not all, but a lot of people left the US or changed the allocation to have a reduced exposure to the US because of the
okay,
unknowns about the administration and the policies and tariffs and everything else. And they went elsewhere. And they went elsewhere around the world because the global central bankers around the world, all of them were, most of them were very accommodative, meaning fiscal and monetary policies were very accommodative for growth, right? They lowered interest rates. They had fiscal policies that were put in place to help growth. And so you did see better than expected global growth. So it makes sense people want to have exposure there. I think now you want to be a little more selective. I do worry about Europe quite a bit. I'd love your take on it, but I think they are the ones that are going to get the brunt of this war and see a lot more of a slowdown and in terms of growth. And I think that they could see some sort of stagflation if we don't get this oil and the crude situation resolved. Now, that being said, I think there's a lot of opportunity. We talked about Brazil last time. I'm a big bull on Brazil. Japan has come back and it's corrected, and they have a wonderful problem where they're actually raising rates to normalize policy for the first time in
right.
decades. And I think there are pockets within India and pockets within China. So I think there are places. I think I just want to be a little bit more careful, a little more selective. There's a lot of hot money around the world, and I think I feel comfortable owning some, but no more than, in my mind, no more than 10% in a portfolio because you do tend to get, you know, booms and busts internationally. So I think you want to be careful. Now, commodities, I do believe that there are reasons to own commodities. I wouldn't chase gold. I wouldn't chase silver, even with the pullbacks. But I understand why they have done what they have done. I've been encouraged that it's actually bounced back, right? It's up 17%
Uh,
lows, which is interesting.
very, very interesting. Stephanie, my thoughts on Europe, just to sort of play it back to you. In a romantic notion, I've been returning to Europe all my life, except I've almost lived 30 years in the US. Especially around higher oil or energy prices, Europe is hit double hard. It is
Yeah.
very difficult in a low performing environment to absorb then these prices. I think Europe, if you want to own it, you have to be extremely selective. And then we talked about it last time. What happens if the conflict is a shorter or short conflict to the dollar? Will there be more euphoria and we see actually an increasing dollar not faring well for some of the assets we hold abroad? Why don't we stay on the cryptos? I didn't have it prepared for us. I'm as surprised as you are. It is telling us something that in a somewhat risk-off environment or cautious environment, something is welling and coming through. What do you make out of that?
It's hard because I have been of the belief it was a risk on asset. And I even have
Yes,
correlation charts between crypto, Bitcoin, and technology and unprofitable technology. The charts are so similar. And so all of
right.
a sudden to see this disconnect, I think that it's an excuse me, it's an outlet beyond currencies. Obviously, people are nervous about traditional currencies. They want to diversify. Just doesn't make, I just can't tell why it all of a sudden turned, but it turned right around the war.
That's right.
It did not go down after the war was announced. So it's clearly telling you people want to diversify into, another asset. I don't know. What do you make of it?
Similar, we have seen a pattern when Russia invaded Ukraine,
Yeah.
and potentially there is seeking of a different safe haven quote unquote,
Yeah.
We don't have enough data points. Likely that's where money then funnels into other than more traditional assets or
Yeah.
currencies to be
Yeah.
determined. We actually should revisit this.
I know.
Stephanie, closing question. We are almost at time. Unbelievable. We sort of chat, and it's always interesting and good spending time with you.
I love it.
If we fast forward 12 months, what do you think will be the single most important theme driving markets that investors may not yet fully appreciate today?
Well, I think a lot's going to happen around the midterm elections. And a lot of that is going to be dependent on what happens to oil prices and gasoline prices and prices at the pump, to me.
Yeah,
Because the longer this goes, the more you will see demand destruction, and you will see voters vote on that theme alone, on inflation. It's out of control because we know it's not just gasoline, right? We know it feeds into everything that we do. So the longer this goes, the more I do worry. But I'm going to take it for for what it's worth. It'll be fairly short term, and we can get through it. And then you're going to have a mixed Congress. If today stands, it looks like you're going to have a mixed Congress. And that's okay to me, Matthias, because you know what happens is the markets actually like a mixed Congress because nothing really gets done. You can't get a lot done. And that actually calms the markets because nothing extreme happens either way. And so I think that's important. So the midterm elections will be important, but it's not going to be the driver of the markets. I think overall is watch CapEx from the hyperscalers. Does that number of $761 billion this year alone, does that start to peak and roll over? Do we see cuts? I don't think so. Not after what NVIDIA said
hmm
today about $1 trillion backlog. But if these companies scale back, that affects the entire food chain, and then we would have a problem because it's many, many, many industries. So there's
Right.
that, and then I would simply say, just yeah, watch out for AI and what it means for the labor market. I think you and I don't necessarily have to worry about AI taking our jobs, but I worry about my 19-year-old when she gets out into the labor force. There's no question in my mind that we're going to have to see a change in terms of what these young kids, how they study, what they want to do, and where they go. But they will be impacted for sure. And so that's something a little bit longer term. I think we have a few years to go on that.
Stephanie, wonderful, great perspective. We're concluding this month Hightower Signature Wealth Fireside Chat. Stephanie, you always delight. Stephanie Link, our Chief Investment Strategist and Head of Investment Solutions at Hightower, and hope to see you again. We chat on another market round and fireside chat.
Thank
Thank
you,
you very much
Matthias.
for joining us today.